Imagine waking up to find your company stock is suddenly 10 times more affordable. That's the exciting news for Netflix employees, as the streaming giant just announced a 10-for-1 stock split, primarily aimed at benefiting its workforce. But what exactly does this mean, and why is it such a big deal? Let's dive in. Netflix Incorporated recently gave the green light to a significant 10-for-1 stock split. In simple terms, this means that for every 1 share of Netflix stock an investor or employee owns, they will now have 10 shares. The total value of their holding remains the same. It's just divided into more pieces. Think of it like cutting a pizza. You still have the same amount of pizza, but it's now in smaller slices. Why do companies do this? The primary reason is to make the stock more accessible to a wider range of investors, including their own employees. When a stock price is very high, it can be a barrier for some people to buy shares. A stock split reduces the price per share, making it more affordable and therefore more appealing. In Netflix's case, this move directly benefits employees who participate in the company's stock option program. Stock options give employees the right to purchase company stock at a predetermined price. If the market price of the stock rises above that predetermined price, the employee can buy the stock at the lower price and then sell it for a profit. But high stock prices can make exercising those options less attractive or even unaffordable for some employees. The stock split effectively lowers the barrier to entry, allowing more employees to benefit from the company's success. It's a way of sharing the wealth and incentivizing employees to contribute to the company's continued growth. It's important to note that this isn't Netflix's first time at the stock split rodeo. This marks the second split for the streaming leader in the last decade, with the previous one being a 7-for-1 split back in July 2015. Before that, in 2004, they also executed a 2-for-1 split. This history shows a consistent strategy of making their stock more accessible as the company has grown. But here's where it gets controversial. Some analysts argue that stock splits are purely cosmetic and don't fundamentally change the value of the company. They contend that a company's true value lies in its earnings, growth prospects, and overall business strategy, not the price of a single share. Others believe that stock splits can create positive momentum by attracting new investors and boosting trading volume. And this is the part most people miss. While the immediate impact of a stock split might seem limited, it can have long-term psychological effects on investors. A lower stock price can make the stock seem more attractive, leading to increased demand and potentially driving the price even higher. It's a bit like a self-fulfilling prophecy. So what do you think? Is this stock split a smart move by Netflix to reward its employees and attract new investors? Or is it just a symbolic gesture with little real impact? Does a lower stock price genuinely make a company more appealing? Or is it all in our heads? Share your thoughts in the comments below. We'd love to hear whether you think this split will truly benefit Netflix and its employees, or if you see it as just a clever financial maneuver.